Jordan Trust here. In this video, we're going to go over the new income tax bill for 2025. Some of the key details and the changes that you're going to want to really take note of. So let's get into that. So the new income tax bill 2025, you have the finance minister, Nirmala, S, her last name, I don't want to mispronounce it, introduced a new income tax bill 2025 in the Lok Sabha of February 13, 2025. This bill aims to replace the existing Income Tax Act of 1961 and is slated to take effect on April 1st, 2026. Now, here are the key highlights on the new income tax bill. You have the simplification. So the bill reduces the number of chapters from 52 to 23 and pages from 1647 to 622, making it more concise and easier to understand. Now, there's also the unified tax year. The concept of assessment year and previous year will be replaced with a single tax year. You have the streamlined language, right? The bill uses clearer language and a more structured layout, reducing cross-references between sections and rules. Please take a moment to hit the subscribe button and the like button. Please take a moment to hit the subscribe button and the like button. You have removal of outdated provisions, so obsolete and redundant provisions have been deleted to modernize the tax system. You have the NRI taxation, right? The non-residential Indians earning Rs 15 lakh, hopefully I'm saying that right, or more in India and not paying taxes elsewhere will be classified as residents for tax purposes. You have the dividend taxation, right? Dividend income for non-residents will be taxed at 20%, while dividends from units in an international financial service center will be taxed at 10%. Now, you should ask yourself, how does this new bill address the compliance burdens for small businesses, right? So the Prove It Act of 2025, recently introduced in Congress, aims to address the compliance burdens for small businesses in several ways. Now, strengthening of regulatory impact analysis is one, right? The bill requires government agencies to more thoroughly analyze the impact of regulations on small businesses, ensuring that the unique challenges faced by smaller companies are considered. Now, you have the increasing small business engagement, right? The legislation seeks to enhance small business participation in the regulatory process, allowing them to provide feedback and insights on the proposed rules. Next, you have addressing loopholes. The Prove It Act targets loopholes in the existing Regulatory Flexibility Act, also known as the RFA, which has been criticized for lack of compliance by administrative agencies. Next, you have minimizing red tape. So by improving the regulatory process, the bill aims to reduce unnecessary bureaucratic hurdles and compliance burdens for small businesses. Enhancing transparency is next, right? The legislation is expected to increase the transparency and accountability of the regulatory process, making it easier for small businesses to understand and comply with regulations. Reducing disproportionate impact, right? The bill recognizes that small businesses often bear a disproportionate burden of regulatory compliance costs and seeks to address this issue. Now, a question that you should ask yourself is, what are the main loopholes in the Regulatory Flexibility Act that the Prove It Act addresses? So the Prove It Act aims to address several key loopholes in the Regulatory Flexibility Act that have allowed federal agencies to bypass proper consideration of small business impacts when creating new regulations, right? One of them is the insufficient analysis. So the bill strengthens requirements for agencies to thoroughly analyze the economic impact of regulations on small businesses before implementation. Next, you have the limited small business engagement, right? It increases small business participation in the regulatory process, allowing them to provide feedback on proposed rules. You have the lack of accountability, right? The legislation creates a mechanism for small businesses to challenge agencies when they fail to consider both direct and indirect costs of regulations. You have inadequate review process, right? It allows small businesses to request a review of agencies' work by their chief advocate in government, ensuring compliance with existing laws. Next, we have insufficient consequences. If regulators fail to comply with the review process, small businesses would be exempt from the agency's regulations altogether. And next we have overlooking indirect impacts. So the act requires agencies to consider both direct and indirect costs of regulations on small businesses, right? You have the duplication and conflict. So agencies often fail to assess whether new rules duplicate or conflict with existing regulations, resulting in overlapping burdens and small businesses, right? So another question you should ask is, how might the unified tax year influence the overall tax burden on small businesses? Again, this simplified compliance. So the unified tax year will reduce the complexity of the tax system, potentially lowering compliance costs for small businesses. Small businesses typically spend proportionately more on tax preparation and record keeping than larger firms. So, this simplification could significantly reduce their overall tax burden. You have the reduced administrative costs. So with a more streamlined tax system, small businesses may spend less time and resources on tax-related administrative tasks, allowing them to focus more on core business operations. You have the potential for lower effective tax rates, right? The simplification of the tax code may lead to fewer deductions and credits. So, but it could also result in fewer overall tax rates. This change might benefit small businesses, especially those currently in higher tax brackets. You have the improved cash flow management. So a unified tax year could make it easier for small businesses to plan and manage their cash flow throughout the year, potentially reducing the financial strain of tax payments and leveling the playing field, right? The elimination of certain deductions and credits that are more accessible to larger businesses could help level the playing field between small and large businesses, potentially reducing the relative tax burden on smaller firms. So that is what I have here today. If you like this video, if you gain value from this video, if you're happy about what you received in this video, hit that subscribe button and the like button right now. If you gain value, if you got what you came here for, please take a moment right now to hit that subscribe button and that like button. See you on the next video.